What's going on, guys? Welcome back to another video. In this video, I've got a really important AMC GME overall market short squeeze update to talk with you guys this weekend. So what we're going to be covering in this update is a little bit of the technical analysis on what we're seeing on AMC on some of the longer time frames. We're going to be taking a brief peek at the Ortex data and some of the options data that we're seeing on AMC, but we have to talk about this new GameStop report that came out due to the actions that took place by Robinhood, Apex Clearing, Citadel in January of 2021. There are some very key things in this report that has come out that I just read that I want you guys to fully be aware of, because it's absolutely insanity what is going on in our financial markets. So before we get into all of that information, guys, if you wouldn't mind hitting that like button down below and subscribe if you guys want some more information like this. Make sure you guys engage with this video, drop some comments down below, hit that like button, helps out a whole lot. This information needs to get out there. So on Friday, AMC closed the day at $12.47, up 42 cents, up 3.5%. Not a bad day with the Russell rebalancing. Little bit of nonsense over here in the after hours with this 8.2 million volume candle, and the price does nothing. I'll do a little bit more research into that and kind of see anything that kind of went wrong at this time period. But for right now, we did see a little bit of a move up on that Russell 1000 rebalancing in AMC's edition, which I do think is a good thing. If you guys have been watching my previous videos, what we've been saying is, yeah, it could cause a little bit of buying pressure coming in, but nothing to the extent that I think some people were thinking it could have, where we were just going to automatically skyrocket to all-time highs. So let's see what happens with this next week. We could see a little bit more buying pressure, and especially if the overall market wants to continue to the upside, well, that would be a really solid thing to see for these two stocks that we really like to hold. Now, when we come over to the Ortex data, we have estimated short interest of the free flow of about 22.53%. It hasn't really changed all that much. Current short interest in terms of shares estimated to be sold short, 116 million. High cost to borrow over here, cost to borrow max, average 24.81%, minimum 3.14. And shares on loan, the current over here, 191.48 million shares on loan. Now, we did have a net borrow of about 272,000, meaning that we could end up seeing a little bit of an increase in the shares on loan. But again, at the end of the day, the bare baseline minimum takeaway that you can have from the data that we're seeing on Ortex is these stocks are still heavily shorted. Now, coming over to the options data over here, I know some of you guys like looking at the options data and some of you guys do not. But in my opinion, I think it's an important metric to look at for the potential, if we're going to see a move, where are the options concentrated, what expiration dates, and what strikes. For this July expiration date right here, we do have 11,000 call contracts in the money, but we have 90,000 put contracts in the money. Remember, when these put contracts run in the money, the market makers are going to be shorting to hedge these puts that they are selling. But when these puts end up running out of the money, they buy those shares back, creating more buying pressure. We see more calls running in the money. 430,000 of them are out of the money at this current time. So there is a potential for a little bit of a run off market maker hedging, but we need to see that initial move up in the stock first in order to even have that type of conversation. Now, we need to talk about this situation with this new GameStop report that has come out. So guys, if you haven't already, make sure you guys engage with this video. I want to make sure that everybody fully understands the extent of the crime that took place and is still taking place to this day in our financial markets, specifically surrounding AMC, GME, and other stocks that have super high short interest, which we are going to touch on a little bit later in this video. So this is the report that came out. U.S. House Committee on Financial Services, GameStop, how the meme stock market event exposed troubling business practices, inadequate risk management, and the need for legislative and regulatory reform. Now, coming down a little bit further, there were a few key findings of this report. Robinhood's disproportionately high order flow and unique formula for calculating payment for order flow rebates strained several market makers, Citadel, and introduced risk to the stock market. Robinhood's payment for order flow formula became a point of contention between Robinhood and Citadel Securities during the meme stock event. We're going to talk about just how exposed Citadel was a little bit later when we go down a little bit further. But for right now, it was about 60 times higher than they would typically have to pay Robinhood for this type of order flow. The other thing that we have down here Robinhood asserted to the public and testified to the committee that the company was always comfortable with its liquidity leading up to its historic trading restrictions, despite actions undertaken by Robinhood's executive leadership to respond to liquidity issues. Now, we have a couple of more findings down here. Let me see. These key findings are the ones that I really want to focus in on right now. Broker-dealers facing the greatest operational and liquidity concerns took the most extensive trading restrictions, although multiple broker-dealers introduced trading restrictions for a variety of risk management reasons during the meme stock market event. Most of the firms the committee spoke to do not have explicit plans to change their policies for how they will meet their collateral requirements during extreme market volatility or adopt trading restrictions when market volatility may warrant their introduction. What this means right here, nothing's changed. These brokers are still operating under these same capital requirements, and they don't have any plan to adjust this in the case that this event actually starts to happen again. But we've seen a couple of events take place like this. Redbox, option chain, goes to position close only. We also saw the halts on AMC and GME a couple of months ago, which we are going to touch on in detail because this is very important for these institutions and the powers that be trying to stop the squeeze with everything that they have. The Depository Trust and Clearing Corporation waived $9.7 billion of collateral requirements on January 28, 2021. The DTCC lacks detailed written policies and procedures for waiver or modification of a disincentive charge it calculates for brokers that are deemed to be undercapitalized and has regularly waived such charges during periods of acute volatility in the 2 years before the meme stock market event. Now, this $9.7 billion of collateral that Robinhood was actually supposed to put up, or some of these other institutions were supposed to put up, remember, from the previous reports that we have seen, Robinhood's collateral requirements were significantly decreased due to the fact that they agreed to go position close only. Now, I want to bring you guys over to something that I think some of you may have seen. I have just recently seen this in the conversations in Robinhood employees. This screenshot right here. This is a conversation between Robinhood employees, and it shows they knew. Us PCO will trigger a crash, I am certain, says the head of data science. It's a bad look. We are supposed to support the retail. So they know. Everybody kind of knows this by now, but there's just more evidence coming out almost every single month that Robinhood knew what they were doing was going to harm retail investors, but they did it anyway to save their own business and their own wallet. So moving on a little bit here, another thing that we need to talk about as well is this Apex Clearing Corporation statement right here from Bill Capuzzi. So remember what we were talking about a couple of minutes ago, where none of these, maybe the clearing firms or the brokerages, had really had a plan put in place to deal with a situation like this again, in terms of a significant increase in their collateral requirements, essentially a giant margin call to the brokers like a Robinhood. And so if the question is, do I think it's going to happen again? The answer is yes, for sure, no doubt about it. How it's going to manifest itself, I'm not sure, but for sure, it's going to happen again. And we've seen kind of little instances of this, but can it happen again in a very, very significant way? All of us believe absolutely. Now, coming down a little bit further here, this is where we start to get into some of the things that I think are wildly manipulative. So these are some of the recommendations. In summary, these recommendations include the following: understanding the influx of retail investors. This is the key one right here. The SEC should consider ways to implement trading halts tailored to respond to concentrated volatility in a limited number of stocks. Oh, we're very aware of what they can do with this volatility halts on these small groups of stocks. Remember what happened here on the run to 34 when we saw that halt on March 29th? Randomly, halt. Well, the SEC or FINRA or one of these other larger institutions might have taken some of these recommendations a little bit too seriously in that instant right there. Remember, we all thought we got screwed over on that run, and this could be the reason why right here, some of these recommendations that we are seeing. Now, the other thing that I really want to talk with you guys in this report, I know there's going to be a lot of other people covering this as well. These are some of the key things that I found in this that I do want to share with you guys. Coming down a little bit further to page 40, the payment for order flow situation and the relationship between Citadel and Robinhood. Remember, Ken Griffin and Vlad Tenev basically came out and said that they were not in communication during this period of time. But Citadel Securities employees estimated that payment for order flow rebates it owed Robinhood for GameStop the week of January 28th were approximately 60 times greater than the week before. An employee for Citadel described Robinhood's payment for order flow rebates as a runaway freight train in the days leading up to January 28th. So obviously they're in communication here. There's not really any debate about this. It's just legal mumbo jumbo nuances where they're saying, oh yeah, Ken Griffin didn't actually speak to Vlad Tenev, but Robinhood and Citadel were in communication at this time. What was the extent of those communications? Well, we don't really have a lot of information about that. We are continuously getting new information, but we still don't understand the full extent of what happened during January 28th, 2021, with hard and cold facts. We all know what happened, but it would be great to see even more things start to come out about this, and this report, I think, does a very good job of that. So that is going to wrap up this update on AMC and this entire situation with what they're trying to do to almost limit squeezes from now on. So if you guys enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So hope you guys are having a great weekend, and I'll see you guys in the next one.